Just 1 minute ago, the Federal Reserve quietly activated a rule so extreme, so unprecedented, that major U.S. banks were forced to immediately freeze critical operations. Most Americans still have no idea what this means for their money, but Warren Buffett just issued a warning that every American needs to hear right now. If you have a bank account, a mortgage, or even a credit card, this next 60 seconds may change everything. Asterisk just moments ago. The Federal Reserve triggered an emergency rule that has not been used in years. A rule so severe that it can only be activated when the financial system is under immediate threat. According to internal sources, the Fed quietly authorized a liquidity control mechanism designed to prevent a sudden bank run scenario. They did not announce it publicly. They did not hold a press conference. They did not release details to the American people. Instead, the rule was activated silently, behind closed doors, suggesting that the situation may be far more unstable than anyone expected. So why was this done quietly? Because any public announcement could have caused instant panic. If Americans heard that banks were tightening withdrawals or freezing certain operations, millions might rush to pull out their money, triggering the very collapse the Fed is trying to avoid. By activating the rule in silence, the Federal Reserve bought itself time. But this time may be extremely limited. What does this mean for us banks? The emergency rule essentially forces banks to hold more cash, restrict certain outflows, and slow down higher-risk transactions. That means banks may not approve large withdrawals instantly. They may delay transfers. They may quietly reduce credit availability. In simple terms, the system is being locked down from the inside. The immediate impact is already being felt. Liquidity inside several mid-sized banks has tightened sharply. Internal metrics show slower processing times and restricted movement of funds. Early reports suggest that some customers attempting large withdrawals are being told to return later or complete additional verification. These are classic early signs of financial stress, signs the Fed clearly understood before anyone else did. Warren Buffett's reaction to the sudden activation of the emergency Fed rule was immediate and unusually direct. Known for staying calm during financial storms, Buffett did not try to soften his message this time. Instead, he issued a blunt warning to Americans. When the Fed moves quietly, it means the real danger is already in motion. Those words alone signal that this situation is more serious than most people realize. Buffett emphasized that the silent activation of a liquidity control rule is not a small adjustment or a technical Federal Reserve tweak. It is a signal that the banking system is under significant pressure and that regulators are scrambling to contain damage before the public notices. For anyone paying attention, this is the kind of moment Buffett has warned about for decades. His message about bank safety and deposits was equally clear. Buffett acknowledged that most large U.S. banks are structurally stronger than they were in 2008. But he also stressed that no bank is immune to sudden liquidity drains. Banks do not fail because they are out of profit. Banks fail because they are out of cash, he said. And when the Fed freezes or restricts liquidity, it means banks are operating close to that danger zone. He warned Americans to pay close attention to any delays in withdrawals, unusual verification steps, or sudden changes in bank policies, because these are the earliest signs of internal stress that customers rarely notice until it's too late. Buffett believes the next phase is predictable, a tightening cycle across the entire financial system. He expects more restrictions on large transfers, slower processing of withdrawals, and increased caution from banks dealing with risky loans. He also suggests that small and mid-sized banks are the most vulnerable in this environment. According to him, if pressure continues to build, some institutions may face forced mergers, emergency bailouts, or controlled shutdowns designed to prevent contagion. In terms of steps ordinary people should take, Buffett's advice is practical and focused on protection, not panic. First, he urges Americans to diversify where they hold their money and avoid keeping all funds in a single account, especially if it is above FDIC insurance limits. Second, he recommends reducing unnecessary debt and securing access to emergency cash. because banks may impose temporary withdrawal limits without public announcements. Third, Buffett encourages people to strengthen their financial discipline, build a safety cushion, avoid higher-risk investments, and prioritize stability over speculation during uncertain times. Finally, he warns against reacting out of fear. Preparation, he says, is far more powerful than panic, especially when the system is signaling stress long before the public sees the full picture. The hidden trigger behind the Fed's sudden move was not a single event, but a combination of financial pressures that quietly escalated behind the scenes. According to internal data sources, several regional banks reported rapid liquidity drains over the last 72 hours, withdrawals far larger than what their daily operations could safely manage. At the same time, short-term funding markets, where banks borrow overnight to maintain stability, began showing unusual strain. Interest rates spiked sharply, signaling that institutions were becoming afraid to lend to one another. This kind of freeze is one of the earliest red flags in any brewing financial crisis, and it forced the Federal Reserve to activate an emergency rule before the situation slipped out of control. The real financial indicators that almost no one is talking about are even more alarming. A sudden surge in corporate loan defaults, rising credit card delinquencies, and a drop in commercial real estate valuations have quietly created a dangerous pressure point across the banking sector. These are the exact indicators that triggered the 2008 collapse, yet they're being overshadowed by surface-level economic headlines that make everything appear stable. In reality, the cracks are widening beneath the system, and the Fed's silent intervention shows they see the threat clearly. Right now, the banks most affected are the mid-sized institutions heavily exposed to commercial real estate, small business lending, and higher-risk consumer credit. These banks depend on steady liquidity to function, and the recent outflows have left them vulnerable. Some have already begun limiting internal cash movement and tightening approval for large withdrawals. Early signs of stress that the public rarely notices. What makes this situation capable of spreading faster than 2008 is the speed of digital banking. Today, people can move billions with a few taps on their phone, and social media spreads panic in seconds. In 2008, a bank run took days. Now it can happen in minutes. That is why the Fed's move was sudden and silent. They know that one spark could ignite a nationwide liquidity crisis before they have any chance to respond. Warren Buffett's survival strategy during financial turmoil comes from decades of navigating crashes that shook the global economy. From the stagflation of the 1970s to the 2008 financial meltdown and the 2020 pandemic shock, his experience allows him to see danger before the public realizes it, understanding what causes banks to fail, markets to panic, and ordinary people to lose control of their finances. That's why his warning, "Only a few will walk out safely this time," carries such weight. Buffett believes the current stress is more structural than temporary. Many Americans rely on assumptions from the past: stable banks, predictable interest rates, and guaranteed liquidity, but emergency Fed rules and early bank strain show that the rules have changed. Complacency now could be costly. Buffett avoids industries heavily dependent on debt, speculative tech firms, and volatile commodities. He is cautious about commercial real estate, especially office buildings, and warns against assets inflated purely by hype, which collapse fastest under stress. In contrast, he prefers safe cash-generating companies, essential services, and U.S. Treasury bills, focusing on stability and capital preservation rather than risky gains. Cash, he says, provides flexibility during uncertainty. For ordinary Americans, Buffett recommends practical steps: diversify deposits across institutions to stay within insurance limits, reduce high-interest debt, and maintain an emergency cash buffer covering at least 3 months of expenses. He urges avoiding emotional decisions, no panic selling, no impulsive investments, and focusing on long-term financial security. By preparing calmly and early, people can protect themselves even as the banking system faces unprecedented pressure. Buffett's advice is simple: focus on safety, preserve capital, and act before fear becomes unavoidable.